Stock investors, they are worried about the Fed pulling away the punch bowl. We saw that in today's market. But how about the bond market? It's watching inflation, which is trailing the Fed's 2% target. That's a sign the Fed won't be quick to end its bond buying binge. The man at the helm of the world's biggest bond fund says we got about another year to drink up. PIMCO's Bill Gross tweeted this morning, the Fed will never sell what they now own, but will stop buying more at some point. The question is when. Growth dependent. We estimate January 2014. Bill Gross joining us right now from PIMCO in Newport Beach. Hello, Bill. What do you think? Is this the end of quantitative easing as we know it?
Well, not yet, as my tweet indicated. I think it's growth dependent, Trish, and you know, what type of growth would be necessary to end quantitative easing? Probably something like 3 to 3.5% for a number of quarters, and probably something approaching a 7% or even a 6.5% unemployment rate. And so, you know, we don't think we're there yet. Obviously, yesterday the minutes raised the possibility. There's dissension amongst the participants and the governors, so to speak, but the three primary musketeers, the three musketeers we call them, Bernanke, Yellen, and Dudley, are in firm command, and we don't think anything's going to happen for at least 10 months.
Okay, 2014 would be the your target. Why 2014? I mean, you mentioned that we'd have to see a number of quarters of 3.5% growth. I mean, does it feel like it's coming in the near future?
Well, it would feel like it's coming if we didn't have, you know, fiscal austerity and the pullback in terms of government spending, or the potential pullback. You know, to our way of thinking, housing and other housing-related industries are pulling the economy forward, but probably only at a 2% pace. And, you know, as we know, the Fed has indicated, not for the purposes of quantitative easing specifically, but in terms of their policy rate, raising that 25 basis point policy rate, that they would need at least 6.5% unemployment and perhaps 2.5% or higher inflation for 1 to 2 years. And we're close to those. So, you know, quantitative easing, as it's been announced in terms of a $1 trillion package, an $85 billion monthly package of treasuries and mortgages, you know, we think it continues till at least the end of the year.
Let me ask you, the exit strategy, do you think it will go smoothly? Do you think it's going to be ugly? I mean, how do we get out of the quantitative easing scenario we've been in for so long?
Well, that's very difficult, not just for the Fed, but for other central banks. You know, at the moment, the Bank of Japan is about to enter the pool, so to speak, the deep end, and the Bank of England as well, perhaps with Carney indicating as much. And so, you know, is it easy to get out of the deep end once you get into it? You know, it's very difficult, because the market begins to expect a constant infusion of liquidity, $85 billion a month into the bond market, which extends out, of course, into high yield and equity credit as we move forward. And so, yeah, once you cut that off, once you cut off the check writing and the purse strings, so to speak, it becomes a problematic question in terms of valuation and the ability of markets, stocks and bonds, to continue on.
Well, sometimes you wonder if the three musketeers are really holding all the power. You had a very interesting tweet yesterday, and Bill, I follow you on Twitter. Let me share it with the viewers. You said, bond vigilantes, they are no more. Central bankers are the masters of the universe, but the question is, are they vigilant? Are they?
Well, they're certainly trying to let us know that they're vigilant. I mean, we saw the minutes yesterday, and they're extensive, and they meet, you know, every other month or more frequently, so to speak. And so, you know, are they vigilant? They're vigilant in terms of their targets and objectives. You know, what central banks are trying to do, what the Fed is trying to do, is reflate the economy. That means not only produce 2 to 3 to 4% real growth, but a modicum of inflation in combination, such that we have a 5% nominal GDP environment. You know, are they vigilant in terms of moving towards that goal? Yes. Will they be vigilant in terms of having reached it, then pulling back and not disrupting markets? Yeah, perhaps not. We'll just have to see going forward.
Do you ever worry that they've been irresponsible through all of this? I mean, there's been, of course, so many critics that say this policy is a dangerous one.
Well, I would say this, Trish, and Governor Bernanke has said it as well, that there are negative aspects to these policies. You know, the negative aspects come in various forms. They come potentially with narrow credit spreads and higher risk in terms of asset prices. They come, you know, in terms of market making and liquidity aspects of the market itself. They come, as I've indicated, and PIMCO has tried to advance in terms of an argument that low interest rates themselves, you know, are a negative influence in terms of savings and therefore eventual investment. So there are ultimately and presently negatives, you know, to these policies. The chairman recognizes that, but what he does recognize going forward is that if he can reflate the economy successfully, that most of those problems will go away. You know, we remain a little bit skeptical, but we're just going to have to see.
Well, Bill, I wonder if part of that skepticism playing out in the market, the 10-year at 197 today, is lower than where it was yesterday. What's your take on that action?
Well, the take is that you know, a less stimulative, a lower quantitative easing future, you know, whenever that occurs, again in PIMCO's mind in 2014 beyond. But if they should, you know, should cut that cord a little bit earlier, that, you know, ultimately that leads to lower inflation and lower real growth, and therefore, you know, the Treasury market has caught a bid based upon that potential expectation. I sort of think otherwise. I think that what the Fed has done in terms of quantitative easing has been to lower what they call, you know, risk spreads and term premiums. And should they cease quantitative easing in terms of buying treasuries and buying mortgages, you know, that those term premiums would go up, and that yields, certainly in the mortgage market and the treasury market, might go up as well.
You know, Bill, as I said, I follow you on Twitter. I know Adam does as well. Tell us, why do you tweet?
Oh, well, it doesn't take very long. You know, I've had my cup. I take my cup of coffee, 1 or 2 cups, and you know, I've got my brain working, and something comes to mind that listeners might, you know, take advantage of or be respectful of. And so, you know, do I tweet what's exactly on my mind? Yes, I do. And in some cases, because of the 140-letter limit, you know, it's hard to get across the message. But you know, I enjoy tweeting.
You wrote earlier this month about a credit supernova that seems to be taking hold, and I want to just pull a quote. You wrote the following, and maybe you can explain this to the viewers. Each additional dollar of credit seems to create less and less heat. In the 1980s, it took $4 of new credit to generate $1 of real GDP. Over the last decade, it's taken $10, and since 2006, $20 to produce the same result. So we're getting less bang for our buck. What's going on here, Bill?
Well, you know, credit has been expanding, Adam, for a long time, since actually forever, since the creation of credit, but certainly since 1971 when Nixon abandoned the gold standard and it was an available, you know, fiat type of currency, speaking of the dollar. And during that period of time, credit, which includes corporate bonds and household debt, et cetera, has expanded from $3 trillion to now $56 trillion over that period of time. You know, less and less bang for that $56 trillion, certainly, because during that process, credit spreads have narrowed, interest rates have come down, and the process of real growth generation from credit expansion has almost necessarily come down as well. You know, it's the same thing as saying that the corporations are less willing to invest in a real economy that returns lower and lower rates of return than they were back in the 70s, in which credit was less available. So as spreads compress and interest rates come down, you almost necessarily have a credit market that is less effective.
Should we be concerned about this, Bill?
Well, I think we should. You know, at some point, the ability of capitalism to expand on the basis of credit expansion is limited. You know, certainly capitalism is correlated specifically to productivity and to the growth in the labor force, but that combination depends upon credit and the successful productivity of credit itself in terms of its expansion and its ability to fertilize in terms of real growth. And I think, you know, going going forward, that yes, we should be concerned about that. It's the same thing as, some have suggested, Robert Gordon, for instance, in suggesting that, all of the low-hanging fruit has been picked. In this case, in terms of credit, much of the gain from credit expansion has already been realized, and so we've got to look for other avenues in terms of real growth going forward.
Let me ask you about something else that concerns a lot of folks, and that's the currency wars that we're seeing begin to heat up. We've got sort of a rush to the bottom, Bill, with Japan and, of course, us printing so much currency that it's creating less value for our dollars or for yen. How much of a worry is this for you in the general scheme of things? Do you worry that we are embarking on a real currency war that could at some point get out of hand?
Well, we don't necessarily think it's a war in terms of firing bullets across borders. Each country, is operating for its own benefit. It happened in the 1930s in terms of competitive devaluations. They didn't call it currency wars back then, but these days, the currency wars are basically fought with quantitative easing and check writing and low and lower policy rates. So, is it a war? Perhaps there is competition between countries in terms of this race to the bottom, this ability to, or willingness at least, proclivity to lower their currency so that their exports and real growth will be, higher than other particular countries. There's nothing wrong with that.
But let's,
go ahead. The question I guess you ask is it dangerous? Does it have potential negatives accompanying it? And I think it does relative to inflation, to the extent that each country, the Bank of Japan, the UK, the United States, perhaps not the ECB in terms of Euroland as much, but to the extent that they're all writing checks, basically what they're doing is inflating and trying to reflate their economies. Is that a danger? It's a danger for the bond market ultimately, to the extent that inflation moves, for instance, in the U.S. to 2 to 3% potentially over the next few years. So that's the danger. It's a danger of fixed income investments relative to real assets, to gold, and to the depreciation of the currency itself.
But the solution, of course, to the 1930s currency war problem, if you would, was Bretton Woods and enacting a gold standard. Do you think that there could be any room in today's world for something similar?
Well, there are certainly those at either the right or the left extremes that suggest that we should have some type of rock or foundation in terms of our ability and banks' ability to generate credit. I think that probably is true, but whether or not the country or the global economy can move back to a gold standard per se, I think that would be very difficult. What central banks need to do going forward is to maintain a semblance of conservative check writing. $1 trillion a year in terms of quantitative easing, that to me and that to the market is not really conservative. It helps to elevate asset prices and to lower interest rates, but in the long run, it's basically inflationary, in terms of its momentum. So, gold standard, let's think about a central bank standard, about central banks becoming vigilantes again, and then we'll talk about gold at some future date.